Happy hump day. It is Wednesday, the Educated Homebuyer Live. This is the spinoff of our podcast where we actually answer your questions live here on YouTube, on Instagram, Facebook, streaming a lot of different places. But we appreciate you being here. We appreciate the support. Josh, tonight, not only are we going to talk about how low interest rates could possibly go, we're going to answer questions. We're going to update on the economy, and we're going to have some fun. So welcome back. Another Wednesday. Haven't seen you in like 3 minutes.
3 to 7 minutes. You haven't talked to me all day. We haven't talked into these cameras in quite some time. So it's good and refreshing to be revisiting these ideas. But it will be helpful. It's an interesting. It's good to talk through it and have that discussion. You are back on mute, my friend. We are not hearing you. I got nothing.
How about now?
Yep. All good. You're back. You're back.
So if you mute it on the mic, it automatically mutes it there. And then if you unmute here, it doesn't unmute it there. Weird. Anyhow, appreciate you guys being here. We're going to start the show as we always do. We're going to answer some questions live. Actually, we're not going to start there. I lied. We're going to go through some charts. Talk about what's happening in the economy. We got some new data out from employment. We're going to talk about, inventory, demand, all of that good stuff. And while we're doing that, it would be helpful if you start throwing questions in now. If you have questions, that way we can just flow right out of the charts that we do right into your questions and make the most of the hour that we have here tonight. So with that said, let us know where you're watching from. It's always helpful to get an idea of where viewers are. I know we got Dixieland over there in Minnesota always showing up. So appreciate the support there. But Josh, let's start as we always do and talk a little bit about inventory here. So inventory, the big, conversation this week, Josh, with inventory is the fact that we actually saw inventory move down a little bit. 696,000 homes down to 687,000 homes, and nothing really to worry about. It's kind of odd for this time of year to see it, but again, it goes back to that Arctic blast or whatever we're calling it that happened, the East Coast there. And basically what that does is it just kind of changes people's plans. People don't do what they originally intended, whether it's putting their homes on the market, that week or the week later. And so things get delayed. So what I would expect is as that clears up, you're probably going to have a higher week than you normally would as that inventory starts to come to the market. But either way, inventory is sitting at roughly 9% higher than it was last year. But a small tick down, which again is a bit out of the ordinary. So we always like to take a look at Huntington Beach in Orange County when we're looking at these numbers. Because that's where we're located. Orange County saw a small tick up. I forgot to put the numbers on the screen there, but we're sitting at 3,290 homes, which I think was like a 2% increase week over week. Huntington Beach actually down a little bit, just over 1%, sitting at 191 properties. So you can kind of see there we're mimicking what happened in Orange County last year, just slightly above those numbers. Whereas in Huntington Beach for the same week last year, we actually had more inventory on the market than we do right now. So just a small tick back, but again, nothing too concerning. We'll continue to watch what those numbers look like. New listings is down week over week, and part of it goes back to what I was just saying a moment ago. That Arctic deal that moved across the Midwest and the East Coast there just limited the number of inventory listings coming to the market. That's one reason inventory is down. That's one reason new listings are down at 48,000 versus 53,000 last year. Continue to watch it, but I would imagine here in the next couple of weeks we get a bump up. Weekly pending sales, we actually also saw a little bit of a decline, Josh. 54,000 versus 57,000. Less homes on the market. Again, people dealing with snow, not out looking for property. We're just going to chalk everything up to bad weather this past week.
It's all weather related.
All weather related. I know we got another chart of the spreads, but you can see, we often talk about the spread between the 10-year and the 30-year fixed and where it was prior to the pandemic and then where it was during the pandemic. And one reason we've actually seen interest rates come down in somewhat of a meaningful way without seeing an improvement in the 10-year is because the spread has improved considerably. I think we're sitting at 1.85, Josh, which is going to show up here on this chart. So that really kind of gauges everything there, shows you really what it looks like.
Yeah, someone threw out a shocking number that if the spreads were where they were in 2023 and the 10-year is where it is, rates are 7.25,
Yep.
7.3%. So that tells you that the underlying yields in the bond market haven't changed much. Just the appetite for mortgage-backed securities, the few of them that are being generated right now, have kept those spreads moderated. And I like to throw this in. The year over year is cool, the way Housing Wire does it, but this is also cool to show you just historically what it's done and how much it's normalized.
I kind of like this chart a little bit better, just because it gives a little bit more of a historical view, and you can kind of just see the volatility. I mean, crazy.
Yeah.
And it looks a lot like interest rates, to be completely honest.
Yes. So we got some fun data this week. This is all loans. What is it? The New York Fed that throws this info out? Yeah, the New York Fed Consumer Credit Panel. This shows you that student loans, which we know, there had a big spike in delinquencies, primarily just because there had been no payments for so long. Some people were unaware the payments started back. Some people were just not in a position to start making payments. But credit cards and student loans have spiked. Autos have gone up a little bit, but important to look down there. Mortgages and HELOCs have not. Basically, have trended up very mildly, but basically where they were better than where they were pre-pandemic. So long way of saying, we talk about people will let almost every one of their obligations, their financial obligations, go before letting their housing payment go. This one here shows you that the chart, because we saw the headline when this came out earlier in the week. Headline was foreclosures are increasing. Well, if we look, they're up a lot from COVID, that era where we had forbearance, but still well below where we were prior to COVID. And what would be considered normal, we're still on the low end. They are increasing, but ever so slightly in that regard. I always like to throw this chart in there. It's interesting, maybe only to me, but it shows you by state what areas were worst. So we know that California was pretty heavy during the GFC, and California is performing better than most places. So what are we seeing? Florida and the Southwest, basically the places that you would expect where home prices have moderated or dipped, is where you're seeing more homes go late. And part of the reason for that, we talk about this all the time, is how strong mortgage originations have been. If you look at the left side of that chart going back to 2023, we had, what is that? 10% of mortgage originations being made to people with 659 or lower scores, and an appreciable number of loans to people with sub 620s. Now, there's very, very few of those being done. Generally, those are to homeowners with a ton of equity who don't have great credit and are able to tap that equity because they have so much. Probably a better look at this is this next chart here. It shows credit score at origination. And what do we have? The 50th percentile is at like 770, meaning about half of loans are being done for people with 770 or higher credit scores. And that 25th percentile is still at like 715 or so. So 75% of borrowers have a credit score of 720 or above, and 90% are above that 660 level. So we talk about that a lot. It is important to be able to maximize and manage your credit score so that you get the best terms, because these are the folks that are getting loans and they're successfully navigating the current market. So Jeb, you had talked about, we got a lot of employment information over the last week since we were here last. Part of when we're looking forward of what's going to happen next with interest rates, how will rates go lower? How low can they go? It's dependent on jobs and inflation, and jobs are probably more important than inflation right now. And what is it telling us? You can basically tell this chart is a composite of the BLS data, which we got today. This chart came out before the data that we got today. So you'll see it was a surprise to the upside, a big surprise to the upside. Revelio and then ADP. And all of that data is telling a similar story. It's a weakening job market, but it's not weak. It's not terrible. And Guy Berger does a really good job of following this stuff. And that's basically his take on it. He thinks it will be weaker throughout the rest of the year, but it's not falling off a cliff. We're not going to have unemployment spiking. And if we don't see that, you're not going to see massive Fed intervention, and you're not going to see rates moving a bunch lower. So a little bit of a recap here. Challenger job cuts at 108,000 job cuts in the January report. So that's you often see a spike towards the beginning of the year because employers hold off job cuts through the holidays. They don't want to fire people at Thanksgiving, Christmas, so they can't put gifts under the tree. So you do see them spike at the beginning of the year, but that's a big number. Revelio was weak. ADP last week was weak. So the expectation today was that we would have weak non-farm payroll numbers. I think what were they saying? 70,000 was the expectation going on the way in, Jeb.
Something like that.
And we got 130,000. There were downward revisions to the last 2 months, so both of them under 50,000. So we'll see. We'll see if we get an downward revision to that next month, but it definitely was surprising and didn't really help. The bond market shook it off pretty well, essentially flat, tiny bit worse on the day, but did take that with a grain of salt there. This chart here is just showing us what's happening there with inflation. So not a big change in this week over week, but if you look, all of these are moderating back towards that 2%. So we're going to get on Friday the CPI figures for January. We have really big figures for last year falling off, being replaced by really moderate numbers if the Cleveland Fed's nowcast is accurate. So when we look at that Friday, we should get a big improvement, at least in terms of the headlines. The markets understand base year effects. They can reverse engineer these numbers just like we are here. So most people are expecting a big improvement in those figures on Friday. Hopefully we get them. There's the chart again, just showing the 12-month ago figures were very, very high that we're going to have falling off. This still, Jeb, continues to astound me that this number continues to go down. That is like falling off of a cliff. In the time that we've been following Trueflation, probably what, 2.5 years now, I don't know that we've ever seen a straight line down over a matter of 60 days or so like that. So it'll be interesting to see if that is truly predictive of where inflation is going, because if so, it will drag rates lower. This is a look at the 10-year. You can see we have been in an uptrend here going all the way back to the end of October. It looked like a sideways trend for a period of time, but you can see pretty clearly that is an up channel there. We hit the top of it, got up close to 4.3, and now we are down towards the bottom of that channel. It'll be interesting to see if we can break out of the bottom, but at best, we're probably looking at a sideways range between 4.1 and 4.2 on the 10-year. So when we look at that, what does it mean for interest rates? The 30-year fixed up 0.03 from yesterday, down 0.06 from a week ago, and up 0.08 from a month. So really nothing. We're still just looking at a very flat market and not a whole lot likely to move us out of it. In the last 7 days, we've got all the jobs data and we're getting CPI on Friday. So if we don't break below 4.1, it's probably unlikely that we're going to break out of this range anytime soon.
Yeah. Did you want to talk about where rates are this week, or?
I did. I just failed to advance the slide.
I just failed to do the slide. So let's talk about, Josh, the idea of interest rates going lower, because I think that's what people really want to know. It's the title of tonight's episode. How low can interest rates really go? And I think the conversation that you and I are having off air is an interesting conversation, and it's one that I think could provide a lot of not relief, but a lot of answers to the questions that people have. So, when I ask you just yes or no, do you think interest rates can go significantly lower from here in the next 3 to 4 months? Your answer would be what?
If we define significantly as like 0.5% or more, I don't think so.
Right. And the primary reason is what I'm going to guess is, likely not going to have any changes in the Fed with regards to cuts. Doesn't look like inflation data is going to. Well, I think inflation data is kind of already built in that we know it's headed towards 2%. So a meaningful beat in inflation maybe helps out interest rates a little bit. But the big driver here is employment. And I think based on the numbers that we're seeing, Josh, even with revisions, we're a couple of months out before those numbers get revised, and we only get those reports really once a month that really have a true impact. So we're in February now. So the idea of anything significantly happening in the next 2 to 3 months, I think, is probably fairly low. I mean,
Hey, Jeb, our elected officials could shut the government down 3 to 4 more times between now and then to argue about things that don't help any of us, which could delay the data even more. It could hold up the confirmation for Kevin Warsh. Any number of things could hold up improvement here. But there's an underlying belief that inflation is moderating, but at a slower pace than most people want, that employment is weakening, but at a pretty moderate pace. And most people, it's a low hire, low fire environment. So unless you're out of a job, most people aren't feeling it. And we're not going to have clarity from the Fed's perspective till middle of the year. So it probably tells us that we're going to be sideways in this range for the first half of the year. So what does it mean in terms of an actual interest rate? Logan was on their podcast yesterday morning. He said, hey, I have a very hard time seeing the 10-year under 3.8. So 3.8 with a 1.8 spread where we're at right now is about 5.6% best case. So that's about a 3/8 improvement from where we're at right now, 3/8 to maybe a half. And that to me is absolute best case over the first half of the year. And I wouldn't count on it. I wouldn't hold my breath for it either.
Yeah, no, I mean, I think there's a possibility you see it in 2026. I just don't see a world in which it happens in the next 60 to 90 days because of just the way things are trending. The only reason we're even here right now is because a statement was thrown out by President Trump about buying mortgage-backed securities, $200 billion worth, Fannie and Freddie, and spreads improved significantly. Otherwise, we'd probably be sitting at 6 3/8 or so, essentially where we kind of ended the year, and you know, status quo for the most part. So I think if you're wondering how low interest rates can go, I would say probably not going to be that big of a change here in the near future. The possibility of them going lower, I think, is there, but I think there's the possibility of them just kind of moving sideways as well. I don't know that you'll see significantly higher rates from here. I think our threshold is still in on that point, but for the time being, this is where we are. So with that, if you have questions, want to get in touch with Josh, pre-approval, need a realtor anywhere in the United States, you can get in touch with us using that link in the description of the video. jebsmith.net/start will get you in touch with me and we can guide you in the right direction. So Josh, we have a couple questions here to start the show. And a couple questions on Instagram too. I mean, this one on Instagram is hard to answer, but someone asked about refinancing. Is it smart to take out cash when you refinance or get a lower monthly payment? So here's what I'll say about that, Josh. I'm going to jump in and just kind of answer my thing.
This is going to make the show easy for me. I'm just going to listen to you.
Well, during the pandemic, when interest rates were 2.9%, I refinanced. At the time, I think I was at like a 3.75 or something. I refinanced to a 2.9. In hindsight, I wish I would have pulled out a ton of cash at that 2.9% interest rate. Now, it probably would have been a slightly higher rate because it was a cash out refinance, but there was a lot of equity, so on and so forth. I wish I had done it then because of opportunities now and so on and so forth. I didn't do it. It is what it is. But is there a time when it makes sense to pull cash out versus just going with the lower monthly payment?
Yes, but for most people that are looking to refinance right now, they put 3%, 5%, 10% down. Their home is flat in value or it's gone up 2% or 5%. So they're over 80%. If you're over 80%, taking cash out absolutely does not make sense. VA will allow you to go to 100%, but over 90%, you're going to pay a premium for it. Cash out is always going to have a slightly higher interest rate. Most people in the market right now to refinance are one of two things. It's rate driven. I bought in the last 2-3 years at a much higher interest rate, or I have way too much debt that's at much higher interest rates. So we have people that are paying off 4.5%, 5% mortgages, but also knocking out $100,000 of higher rate debt, whether that's a second mortgage, whether it's a bunch of stuff that they've accumulated through the years, whether that be for home improvements or just paying the bills, putting the kids through college. We can look at a blended rate for that. But for most people, just paying off or just I would like some extra cash in hand. The difference there is not it's not helpful in terms of the interest rate. So what you can do on Fannie Freddie deals, you can get 1% of the loan amount back at closing without it being considered cash back. So that's helpful. If you want sort of a quasi cash out, you can do that. You can set it up to skip 2 payments. We had some listeners here in Long Beach, probably 18 months ago. We helped with the refi, and they had bought a fixer, bitchin' house, did a full renovation. They owed $24,000 on a credit card. They're like, we need the money to pay this off. So we skipped 2 payments. We got them back $6,000 or $7,000, closing like a $700,000 loan. And with all that factored in and the refund they got of their impound account, it put them at like $24,000. So there's some things you can do to get a little bit of cash back. But just remember, with current interest rates, it's about $6 per thousand. For those people to get that $24,000, it was about $150 more a month, $140 more a month than what it otherwise would have been.
Got it. So a question here, Josh, on interest rates. Interest rates and USDA. So how do USDA interest rates compare to what you're seeing out there in the market with, say, FHA, VA, that sort of thing?
So this chart that we show from Mortgage News Daily every week shows FHA and VA, and you guys will notice they're showing 5.7 for FHA right now, 5.72 for VA. There's a distinction without a difference. I don't know how they come up with that difference. USDA loans are going to be priced very, very similar to those. They all get sold in Ginnie Mae pools. It's the Government National Mortgage Association. All of the loans that have a direct government guarantee go into the same pools, and they're going to be priced very, very similarly.
All right, Josh, a question here while we're talking about USDA. I have somebody on Instagram asking how, and you might not know the answer to this, can you give advice to how to finance farmland without putting 40% down? They want to do 20%, but they have excellent credit, so on and so forth.
It's just a whole different animal. If we're not talking, if you have a hobby farm that it's really the house and a little bit of the land is the value, you can do that. You can have a hobby farm. If there's a working farm, it's really more of a business loan. That's why you're talking about these big down payments, because it's not just you buying a house and saying, I have a separate income. It's, hey, I need to farm this land and I'm going to make my living off of it. It's more of a business loan.
No, got it. Yeah. So, and yeah, if you were buying residential real estate and there was farmland around it, so to speak, and that's part of, it's not necessarily a business, you could do it. But it's a whole different process, like Josh mentioned. So hopefully that's helpful and answers your question there. All right, Josh, we had another question here about the Fed. It says, if the Fed cuts 100 basis points, which I don't see happening this year unless something crazy happens, but the 10-year doesn't move because inflation expectations stay sticky, do mortgage rates actually fall meaningfully, or are we structurally stuck to a higher rate regime?
I don't know that it's at this point inflation concerns. I think that's kind of abated, and people are looking at it going, in the interim, short term, so 2, 3, 5 years, we're probably going back to that 2%. For the longer term stuff, 10-year treasuries, 30 years, saying the government has not put the brakes on the spending. We're spending too much money. We're now spending too much money paying the interest on the money that we spent that we didn't have, and that's the concern. So is it possible? Yeah. Do I feel like we're stuck here and it can't go lower? I don't. The rubber will hit the road when you get something slowing significantly. So when we see it, we'll find out how the market adjusts. I think it will go lower. We've all kind of, our mind's been warped by remembering COVID, when you had like 1% rates below 1% for periods of time in terms of treasuries, long-term treasuries. You're like, that's mind-boggling. So going back there, no. But if we're at 4.2, could I see a 2% 10-year treasury? I could. It's going to take time, and the market's going to have to put the last 4 years out of their memory.
So, Josh, when it comes to loans and financing, is there any loan program out there that says you can't have, or that you can have too much money in the bank? You have too much money, I'm not giving you a loan.
I believe so. The question here specifically is about USDA, and we don't do a ton of them just because most of our markets, they're not here, and it is a very, very restrictive program. I hate saying that because you have that lurker that works for the USDA that wants to reach out. So I have not actually seen the guideline. They're more focused on, you can't make too much money. And then when I say it's restrictive, so you have a limit on your income, for your household income, and then you have a really restrictive debt to income ratio that they just reduced from 34% to 29%.
Yeah, but I don't think any of that applies to how much money you have in the bank. Like, I don't think you can have too much money in the bank.
I don't believe so. I've heard people saying some things. I've never seen the guideline. We can dig into it. I'll do a little research here while
does your GPT not have USDA built in?
No, it does, but I'm trying to talk instead of, so what
Well,
I'm saying
get
is
the answers here. There's people here for answers, Josh.
I
It's
will
not
throw
about
it in here
this
while
show is not about
answering
you.
other questions.
It's about Drew. Drew wants an answer here. So let's answer Drew.
You've got a household income limit, but I'm not seeing anything here in terms of a limit on it. But we can dig in. I'll pull up the USDA guidelines.
Yeah, the only time I've ever seen any sort of limit type thing on how much money you can have is sometimes when it comes to down payment assistance and some of that stuff. I think too much money in the bank can be a problem. But outside of that, I'm not aware of any. And even then, that was long ago, and I don't even know if that's still the case. So hopefully that's helpful for you. So this week, we did an episode on the Educated Homebuyer podcast, which is on the Educated Homebuyer podcast channel, Spotify, Apple, all those places as well, where we talked about the next 60 days being the kind of the deciding factor for what the market looks like in 2026. And it seems to be a pretty popular episode. So if you haven't listened, make sure you go check it out. On top of that, we recorded an episode today talking about, one of the questions we get all the time here on the show is, should I buy a house? Should I buy? Should I wait? And today we kind of took a different approach and we said, hey, this is when you should absolutely not buy a house. And we talked about the reasons in there of the things that we see and the reasons that we believe you shouldn't be buying. And one of those made me think of a question that we have here, Josh, from a listener or a viewer on Instagram. And he says the OC median home price is over $1 million. Is it better to buy in Vegas where new homes can be found for $500,000? Should we buy there instead, or is it risky because it's hard to resell later? And it made me think of one of the things that we talked about in there. And that's like people buying in areas that they're not familiar with just because they can get a lower house price without understanding where they need to be in that market, what that market actually looks like, all of those details. So when you hear that question, Josh, what's immediate thought?
If we're just investing out there, I want to look at, there's two pieces when we're analyzing an investment. What's my cash on cash return? So how much money do I have to put into it? What does it yield in terms of rents above and beyond any mortgage payment? And then what is the prospects for long-term appreciation?
Yeah, but if it's not an investment, what if I'm thinking, hey, listen, OC's too expensive. What if I just buy a house in Vegas? Is that the way to think?
But is it buying it as an investment, or we're going to move to Vegas?
You're going to move to Vegas.
If you're comfortable with it, we did a show, Jeb, you may or may not remember, the first year that we did the podcast on moving to a lower cost of living area to be able to afford to own a home. Because we have people all the time that insist on, sure, I've got family here in Southern California. I love to surf. I'm 2 blocks from the ocean. My apartment is $3,400 a month, but I can hop up at 5 a.m. and be in the water by 5:15. Like, okay, I get it. Those are all valuable things. But we have a lot of people that reach out from the South. And I have young couples, husband makes $100,000, $110,000, $120,000, which is good money, but wife gets to stay home and they get to buy a $350,000, $400,000 house that they can easily afford on one income. So you say, do I want to live in Alabama? Do I want to live in Georgia? Not necessarily, but if I was 28 years old and getting ready to get married and didn't want my wife to have to work, my spouse to have to work, and I wanted to be able to own a home and be able to build up equity and arrive at retirement with a home free and clear, I think it's a worthwhile trade-off. Do I think it's going to do the same? I don't think that Nevada or Georgia or any of these other places are going to do as well long-term as places that are fully built out, like Southern California, like the Bay Area, like New York City. But we've seen over time areas like when I went to Eastern Washington University. When I graduated from college and got into this business, it was always like, oh, look how much more affordable it is there. And they have actually performed just as well, if not better, appreciation wise over the last 25, 30 years. And the numbers are much more similar to what we have here. Same thing with North Idaho. So Boise, we can name all of these markets that we used to have a much bigger multiple in California of those values. So it's a personal decision. I don't think that your primary residence, the number one thing about it is the investment.
Understood. No, and I think that's the way to think. Another question here, Josh, that I think we need to touch on says, can you tell us why everywhere house prices are going down? They're going down everywhere, but Illinois is going up and up and up. And I think that is a huge misunderstanding. I don't know if it's something you read, a headline, not understanding the data, but the reality is the majority of the United States is moving sideways to up. a lot like what's happening there in Illinois. So, you hear headlines, home prices are down. And yes, are they down in some areas from 2020? The answer is yes, they are. For 2022, the answer is yes, they are from the peak. Some of those markets are. But when you look back from 2020 on, we showed a chart last week, even these markets that are down from 2022 are up considerably from 2020. So house prices here in Southern California aren't going down. I mean, they're still going up in most markets, sideways, worst case, but rarely do I see something selling for where it sold, a couple years ago. So I think it's just a misunderstanding of what's actually happening out there. And my guess is, Chicago, Illinois, I mean, same place, but anywhere in Illinois, Chicago, that area, it's in demand, right? Jobs, growth, limited supply of
Well,
homes, like it's built out. It's a
Jed,
supply demand thing.
anywhere in the upper Midwest, if you look at the heat maps, you look at the charts, the upper Midwest and the Northeast have done very well, because you didn't have this giant influx of people pushing prices higher during COVID, where you had people leaving colder states for warmer places. So you had this big in net migration that pushed prices higher, and those are the ones that are correcting. You didn't have any of that in the upper Midwest and in the Northeast. So all the things that you said, plus on top of that, they're just more stable markets. They're much more affordable. You've seen some of the markets, like you talked about, the markets that have lost the most are some of the ones that did the best. So in terms of total appreciation, they're doing very well. Well, over the last 2 or 3 years, some of the markets that have been the best are like Rust Belt areas, like Pittsburgh, where like no one wanted to go there, and it got so affordable that you're like, well, why would I not go there? I can get a really nice house for $120,000. So they've done better percentage wise than other areas. So as you said, take headlines with a grain of salt, because those are national headlines, sensationalized, and look at local data for where you're interested in. Chicago, Illinois, the upper Midwest, those are not an anomaly. They're whole regions that have performed better than the nation as a whole, which has not lost value.
All right, good stuff. So, Josh, not a lot of questions here on the moment. It does point out his opinion: Texas and Florida definitely going down. Yeah, some of those markets are going down, but not all of them are going down. There are markets in Texas that aren't going down. But like Josh said, some of the markets that are going down are the ones that perform the best. What's happening is you've actually had like some structural changes in those environments that have caused home prices, homes to sit, inventory to build, that sort of thing. HOA dues higher. Because of some of the laws that were passed and reserve requirements that are now in some of those buildings. Insurance cost is up. Texas and Florida are 2 states where you can still build quite a bit. So you got a lot of new construction out there in the market, more supply, less demand with higher rates. All of that stuff impacts that. But those are 2 of the slower markets. But for the most, outside, I think when we're looking, I think there was, last time I looked, Josh, I think there were 19 metros that were back to 2019 levels with regards to inventory, whereas you got the majority of the United States not back at those levels. So it's a supply demand thing. It's always supply demand thing.
Let me throw this up here, and you tell me what your thoughts are on this. This was in Malden's Charts That Matter for this week, Jeb, and we got to remove this one to add this one. Okay. So this is Austin, Texas. Austin has more than twice as many sellers as buyers. So the funny thing here is the sellers have gone to the moon, going from what, 10,000 all the way down during COVID, only 8,000 sellers, and it's up at 18,000. The buyers aren't down that much. Buyers are, yes, during the middle of COVID, we're up at 12,500, 13,000. So this is from their MLS. Actually, it's from Redfin data. So again, take it with a grain of salt, because Redfin loves to do this every month, talk about how many more sellers there are than buyers. Their metric is skewed, but this metric is pretty consistent across time. But I looked at this and I'm like, yeah, you have a few less buyers, which it makes sense with strained affordability in Austin, which really had appreciated a ton. But it was interesting to me seeing that many more sellers per this chart.
Well, I think, I mean, without knowing Texas, right, and just talking out loud here, us having a friendly conversation, I think there's a couple things that go into that. One, people get there and realize this is not what I thought it was. This is not the utopia that I thought it would be. For one reason or another, people move to Texas thinking, hey, it's a red state. I'm going to move and I'm going to go to the popular markets, and they realize they get to Austin and it's not red at all. It's a big blue area, a lot of liberal, you know, area. And so that's one piece of it. The second piece is people get there and taxes are higher from when they bought their house. So they buy their house, then, you know, in 2022, home prices shoot up. Now, guess what? Based on how they do their taxes, my property taxes are now assessed at what the neighbor just purchased their home down the street for. So shit, that affordability sucks. I don't want to, you know, so it's all of these compounding things where people are like, this is not what I thought. I want to get out of here. More sellers, buyers still on the side, you know, kind of staying consistent through that. And then inventory builds for, you know, that reason, plus new construction and all the other things that are happening. So there's a lot going on there. But when you talk to people in Austin, which I have some really good friends that sell real estate there are still pockets there that are doing really well. And there are pockets where there's definitely more supply and just less people want to be there. So, and I think, you know, Josh, we talk about it, you know, when they build these cities out, right? The more and more they build, the further you get from that epicenter, right? Which is where a lot of people think they want, you know, that's kind of why they're going there. They want to be close to the center. And then they realize, well, I'm in Austin, but I'm not really in Austin. I'm out here. I don't have everything that I thought I was going to have, and so on and so forth. So just me talking out loud. But
the greatest thing about Texas, Jeb, is that in any
is their barbecue. That's the only great thing.
Is
about
their
Texas.
barbecue? Is
That's
exactly
the only
what
thing
I
they
was
have
going
going
to say.
for them.
You can go find 3 good barbecue places in any town in Texas, and for us, we're in a giant county and we have one.
Earth. It's the flattest place on earth. I know that. I drove through there, and literally, you stare at the horizon for 13 hours as you go through the state from one side to the other. And once I did that, Josh, I didn't want to go back.
Jeb, during the height of Chip and Joanna Gaines mania, did your wife ever get you to take her down to the silos in Waco?
Nope.
So
Nope.
I went and visited a buddy in Fort Worth, and I had another friend who was in Austin. And so Waco's about halfway. So like, wife, we'll go down there. And it's a cool little thing, but Waco is it's closer to the David Koresh movie than it is the stuff that they show you there in on HGTV.
For sure it is. That is the middle of nowhere. Yeah. Anyhow, so all you people in Waco, we're not shitting on you. Kind of, but sorry. Anyhow, another question. What do you think of Encino market, Josh, in Los Angeles? Encino's an expensive market, right? If I remember correctly. High price
everywhere
market.
In Los Angeles.
Well, Encino, I think
expensive. It's just closer to it's all relative, right? Everywhere up there is a, you know, Pacific Palisades, $3.5 million homes. But Encino, yeah, it's a $2-3 million market. It's expensive.
Yeah. So what do we think of it? I think Los Angeles as a whole, I am not a fan of the county of Los Angeles for many reasons. So I'm out. I'm like, this is like the one show, Josh. I'm out. What's the show called?
So maybe it's not as bad, Jeb. According to Realtor.com, 1,650,000 to 1,009,000 in areas like 91436. And for those of you in other parts of the country going, you're insane. You're talking about nearly $2 million homes. That's going rate for a nice community in Southern California at this point. I mean, that's it's not affordable, but it's nice communities. That's what you're looking at.
There you go. All right. So did you say, is it, I don't know. I couldn't tell if that was Ventura County or not, what she put in there, but Encino might be.
Ventura is underrated.
Ventura's better. Yeah.
Ventura is underrated, but yeah. We got the question: real estate in the Temecula area. What are your feelings on Temecula, Mr. Jeb?
I mean, you can get a really nice house in Temecula for a quote unquote reasonable price compared to Orange County. The problem is you're in Temecula, which again, 6 months out of the year, it's great. But the other 6 months, it's hot as hell, or considerably colder than it is here because you're basically in the desert. So I don't know.
I lived in Temecula for 2 years, Jeb, and the weather to me wasn't bad. I like hot. The weather wasn't bad. Parts of the year, it's amazing. So really good weather. Most of the year, really hot for 60 to 90 days. the biggest thing to me is the traffic. Just you've got
Yeah.
one road in from Orange County and down through San Diego,
Yeah.
and a lot of people have moved out there. So if you have to go into Orange County or Riverside, Orange County, San Diego to work every day, it's brutal. It's just
Yeah.
brutal in terms of the
Yeah.
traffic.
I mean, I'm a fan. I do like the market though. I mean, I sold a house for a client there last year.
Listener to the show.
Listener to the show, 700,000 roughly where we sold that house, 725. And I think that same house in Orange County, depending on the market, would have easily been $1 million to plus, probably closer to $1.5 million, depending on where it was located. So a lot more bang for your buck, but you gotta, it depends. Like if you were saying, hey, I work out there, or I work remotely and so on and so, that's one thing. But if you're like, hey, I work in Orange County and I'm buying in Temecula because it's more affordable, I think that's a whole different conversation and something you got to consider.
Yeah, if you have to commute, I've had so many people do that or go to like worse, like Victorville, and say, I'm going to drive in. We had a listener to the show, Jeb, in the middle of COVID said, I'm getting out of LA. I'll just commute. I only have to go in here 4 days a week. And 2.5 hours each way, 4 days a week, killed them in about 4 months. Thankfully, home prices were shooting to the moon during COVID, and they were able to sell and get their money back and make a little profit.
Yeah, we just had a viewer on Instagram just say, I bought a house in Temecula 2025, December. So just a little bit ago when rates dipped a bit, it worked out pretty well. Ended up getting a solid deal on both the price and the interest rate, and the weather is not that bad. Well, here's the deal. You've only been there since December.
You haven't had the fun part yet.
You talk to me in August and you tell me what the weather's like. But it's all good. Actually got to go to Temecula, Josh, in a couple weeks for a rugby tournament. End of the season rugby tournament.
That sounds fun.
Going to the
it's
polo
not an
field.
August rugby tournament. That would be
awful. The polo fields out there. Yeah, so I get to see Temecula here in the next couple of weeks. What questions do we have? We're low on questions.
We got the show and tell portion of the show. Mr. A. Guzman says he bought a new build in the city of Ventura for 1.2. I really like Ventura. I love Santa Barbara, but Santa Barbara is just way too far out there. You get some of that still coastal vibe there in Ventura, and better prices than more in LA and Orange County.
And not the craziness of LA in the, the building, political, all that crazy stuff that happens there. Actually, I have a good buddy that lives in Ventura and in a bitchin' house, great view, the whole thing. And he loves it up there. So it's, great market if you can do it.
Greg has a great comment. It says they need to build that Corona to OC tunnel already. If Elon put a tunnel in, people would be moving to Temecula like all the time. If you could get in 20, 30 minutes back into Orange County, everybody would go.
Yeah, not everybody. I wouldn't go. I'm not sold.
Your kids want dirt bikes. They want land. $2 million in Temecula will get you an estate.
Oh yeah, it definitely will. I'll actually have a listing coming up there in the next couple of weeks. Not really Temecula, a little bit outside of Temecula, but right there. Anyhow, another conversation for another day. All right. Let's see what we got here, Josh. So I think we're freshly out of questions, comments. Now, if you have a question, now's the time to throw it in, because Josh and I are just sitting here staring at each other.
We're gonna call it Wing Wednesday in a couple minutes. My wife has the air fryer going, and we're ready to hit the wings.
There you go. And making them on the air fryer, dude. You got to make them on the Traeger. I have figured out the formula to make good wings. Grill them on the and smoke them on the Traeger, dude. Top notch. I have to have you guys over and do it.
I don't disagree.
Got the recipe.
They sound spectacular, but 18 minutes from done said to done.
This takes me about 35, 40. Not bad. Good stuff. All right. Guys, that's it. We'll see you next week. Adios.
Amigos.